Good afternoon, everyone. Thank you for joining us for our webinar today. I'd like to start off with a quick acknowledgement of country, and today's acknowledgement is that we've got three presenters, all presenting from three different locations on the land of the Wannerung people. We acknowledge traditional owners of that land, and hopefully, like me, you'll get out later today and actually enjoy some of that land. But in the interim, sit back and enjoy the webinar. A couple of bits of quick housekeeping items right off the bat. The slides and webinar will be sent out to everybody in the days following the conclusion of the webinar. Additionally, we're more than happy for people to post questions over the course of the webinar. We won't answer them as we go. We will, however, attempt to answer them at the end if there's time, but if there's not, we'll get back to you via email in coming days. The second presenter today will be Jamie McCallum. Jamie is a senior associate in our property team. We'll be presenting on topical issues in relation to tax and property transfers. The third and final presenter is Joseph Flanagan. Joe's an associate in our commercial team. We'll be presenting on land tax updates and structuring options in relation to that ever-changing and always fun environment. However, first off, I have the duty, obligation, whatever the correct word is, to introduce myself. And I should say as well, my children, in a sign of their love and adoration for their father, have decided to pass on a virus to me. So apologies if I start coughing and spluttering at some point over the course of the presentation. I'll be talking today about the use and structure of testamentary trusts, particularly in business succession. Now, there's obviously going to be some overlap between the personal, being assets that are dealt with via estates and therefore testamentary trusts, and wider business and existing structure. But that's obviously the nature of a lot of businesses in Australia, particularly those that are family businesses and most prevalently in farming. So additionally, it's the what and the why. So what is a discretionary trust? So there's really very little difference between an interbios or discretionary trust that's established during someone's lifetime and a testamentary trust. The difference, of course, being that we need somebody to die to establish a testamentary trust. The timing and whose death that is, we'll get to in the next slide, but we do obviously need a death. Why are we using the testamentary trust? Well, predominantly it's an asset protection tool. So with key individuals have levels of commercial risk, whether that's through directorships of companies, providing personal guarantees, whatever it is that we have an individual at their level of commercial risk, we might not like to expose assets of them and therefore have a more secure testamentary trust environment. The next 2 points on that slide talking about spendthrifts, gamblers, which could include also drug and alcohol issues, but also unstable relationships, need to be considered not just for the key people who are meant to be in control in the short term, but also potentially future generations who may come into control. As we know, the perpetuity period in Victoria for trust is 80 years. So a testamentary trust established may have a number of different people control it and will benefit from it over time. And it's necessary to consider not just the here and now, but what also may occur in the future. The additional benefit, and it's never a reason that we look to establish a testamentary trust, but it's an ancillary benefit, is obviously the taxation benefit. So ordinarily when we're distributing income from discretionary trusts, once we distribute in excess of $416, we're looking at distributions at top marginal tax rates. Whereas through distributions of income through testamentary trusts, we have the ability for minors to access adult tax rates. So obviously that includes distributions up to the tax-free threshold. Of course, we need to be aware of Section 100A there when we're making distributions to minors but not actually paying them. Hopefully many of you have caught Rob Warnock's presentations on 100A over the recent times, particularly with the ATO's change in view on that section, but if not, I'm sure Rob will be happy to take any specific 100A questions, and I say that without having asked him whether he is happy to do that. So once we've decided we're using the testamentary trust structure, consideration obviously needs to be given to how that structure looks. So whether we're using a single or multiple testamentary trust, that's obviously pretty self-explanatory in terms of whether it's one or two or more trusts involved. But the third option is what we refer to as the alter spouse. So that third option is really where we're saying that a trust is not established on the death of the first person that dies, only established on the death of the second person. So the benefit of that, and what we're referring to as pros here, is no structure worries around for the surviving spouse, and also that surviving spouse has full discretion. Now, we put those under the pro column because that is what people who look to use that particular structure consider to be pros. However, in my view, they're not necessarily pros. You lose the asset protection, you lose the taxation flexibility, but I think most importantly, you lose certainty for the first person to die. So the reason for that is obviously the surviving spouse has that full discretion over business assets that are passing through a testamentary trust. They'll have the ability to dilute or otherwise deal with those assets during their lifetime. And they also have the ability to change or set up a new will in the future for themselves, which may have assets passing away on their death that was not intended from the person who died first. When we're looking at whether we're using a single testament or multiple testamentary trust structure, it's coming down to what's the paramount requirements of the family. So a single testamentary trust is generally going to provide greater asset protection, particularly in sort of the family law sphere, whereas multiple testamentary trusts are giving other benefits. So we use an example here as the alphabet family. The alphabet family creatively named their children A, B, and C for the purposes of keeping it simple. If we have in the multiple trust structure, A as a trustee, A as an appointor, and A as a primary beneficiary, and similar structures for B and C, it's a lot harder to argue that those are assets controlled by or for the benefit of those individuals, and particularly in circumstances like a relationship breakdown of any of the alphabet children. However, if the alphabet children work together in a single testamentary trust, then they are all trustees and appointors and primary beneficiaries, whether themselves or with additional people, it's much harder to argue that any one or more of them has a particular entitlement in the trust. The reason for this is obviously that, as with the discretionary trust, a testamentary trust, nobody has any particular right to income or capital unless or until the trustee makes a distribution in favour of that person. However, on the inverse side of things, for the multiple testamentary trust, there's a significant benefit and flexibility given if there are disparate family groups who are wanting to do different things within their lines. So if there's differing financial and personal circumstances within that line, separate family lines may want to control those entitlements through a testamentary trust without the input of their siblings or their cousins as we move down generations. Additionally, we lose the ability to make family trust elections. Again, it's sort of outside the remit of this presentation to go into family trust elections, but obviously we're looking at having family control within a particular line and a test individual for the purposes of making those elections and tax benefits that come along with those. If we've got multiple family lines involved in the same trust, it's not really going to be possible to make a family trust election within a single trust structure. When we move on and we consider what type of structure we've used, we're then moving on to considering who the primary beneficiaries of the trust should be. So again, that will often be who we're considering will control any business assets that are being transferred through the testamentary trust structure. So whether that's a surviving spouse, whether it's children or grandchildren, and particularly considering if it's a blended family. So if in this circumstance we have matriarch and patriarch who have independent and separate family wealth or family businesses, it's important to consider whether or not it's just whether it's a surviving spouse who has a level of say, whether it's their family line, or whether it's the children from that blended family. Since the Owies decision, we've had another really good highlight about why it's so important to consider who the primary beneficiaries of a trust are. Obviously, Owies was a decision that turned specifically on its facts, but it did still highlight the importance of not really considering who the primary beneficiaries are intended to be at the time of establishment of the testamentary trust. An additional consideration is whether we have any excluded beneficiaries from either a single testamentary trust or one or more in a multiple testamentary trust structure. So excluded beneficiaries may be a child or a particular family line. So if we have business assets passing to a trust for the benefit of A, consider whether excluding B and C and their spouses and lineal descendants. It may include simply just excluding spouses. It may include excluding a former spouse of the testator. Consideration needs to be given to whether we should say the outset, these people are not intended to benefit from the testamentary trust structure. When we spoke earlier about single or multiple testamentary trusts, the first point of discussion, as it often is where we've got multiple children, are we establishing a single or multiple trust for those children? However, that's not the sole consideration when we have business assets passing through an estate and therefore being dealt with by the testamentary trusts. It may well be appropriate that separate trusts are set up for particular purposes. So if we have real property, plant, equipment, intellectual property, whatever it is related to a business, passing through a personal estate, and this is particularly most prevalent in a farming context, consideration should be given to whether specific or bespoke trusts are established for the particular assets that are flowing through relating to the family business, as opposed to the personal wealth that may flow through an individual's estate. Similarly, consideration given to loans and unpaid present entitlements. Obviously, there's lots of people who simply look at those as line items on a balance sheet or something done by accountants for the purposes of tax from year to year. But for the purposes of estate planning and setting up testamentary trust, these are obviously assets owned by the individuals that, if they're not dealt with during lifetime, will be dealt with via their will. So consideration again needs to be given to whether those UPEs or loans are meant to go to a particular direction. So, for example, it may be that in the alphabet family, A is meant to control the family business, and we're giving them control of a company or a trust or both that operate a business outside of the individual's name. And then loans or unpaid present entitlements either may be intended to follow that particular beneficiary. So there's an A trust established to receive those loans or unpaid present entitlements. Or equally, it may be the case that the family's decided those loans and unpaid present entitlements are intended to be made and paid to the family. And therefore, it's appropriate that a trust is established to receive those that is controlled by all of the alphabet children. Obviously, there are separate considerations to be given to things like principal places of residence. So, for example, if they're owned as joint proprietorship in a blended family scenario, it may be that joint proprietorship is severed so that a specific residence trust can take ownership of a half share of a principal residence on the testator's death, so that gives the surviving spouse the ability to continue to reside in that principal residence, but clearly divides the ownership of the principal residence and particularly the capital proceeds on its sale across the family lines for the blended families. The other primary example that we're having at the moment, it's a topic that feeds in nicely to what John will be talking about later, is in relation to the increased land tax. So, for example, if a testator owns 5 properties in their own name, we may well have in the past established a single testamentary trust to own that property. If the properties, for example, are worth $600,000 each, those 5 properties in the same trust sit at $3 million and therefore are sitting at the top land tax rate. However, if we establish 5 separate testamentary trusts through the will to own properties 1, 2, 3, 4, and 5 individually, those properties are taxed at their individual land tax rate at $600,000, which, as you'll see with Joe later on, is a significantly lower rate of land tax. A benefit in Victoria is that our trusts are not grouped for land tax purposes, so the ability to separate out those properties can lead to significant and ongoing financial benefit for the family. As I mentioned earlier, there's the blended family discussion, but there's also a discussion around whether a level of income and or capital should pass directly to the next generation, so grandchildren rather than simply all passing to children. In my view, the most important consideration throughout all of this, not that any are unimportant, but the most important consideration is sitting at that appointor level to determine who will be the appointors within the discretionary trust structure. So traditionally, we've said that appointors are there to remove and replace a trustee. That was traditionally their sole role, but over time that role has expanded to be oftentimes more of the role that we traditionally seen a guardian fulfilling. So if, for example, the consent of an appointor is required to certain things like borrowings, and whether that be external borrowings from a third party like a bank who may seek to encumber assets of the testamentary trust, or whether that be borrowings by way of loans to children, spouses, whoever it is from the testamentary trust, we may require the consent of the appointor to those particular decisions. These are particularly prevalent where we have a scenario where not all children are involved at the trustee level, so they're not all involved in the decision-making level, for whether it's business acumen, family dynamics, whatever it is. But we do want those children to all have a level of say and benefit from the family structure at that higher level. So the benefit of this particular structure may be that we have a couple of individuals in the alphabet family who are trustees, but all three sit at a point or level, which will allow that third child the ability to say, well, if we're making capital or income distributions above a certain figure, or annually when we're looking at financial statements and taxation returns, I have to have a level of say and oversight in those before they're approved or before the trustee makes a certain determination. Additionally, and again most prevalently in a family farming context, if there's a sale of particular assets related to an enterprise, so obviously in the farming context, it's generally the farmland itself, we may have appointors or specific appointors ticking off on those decisions. So obviously when we're considering the role of the appointor and what consent's required there, it becomes very important to consider who may be the appointor. So again, most people will look at it at some point, and the future of those people who are trustees will probably be appointors, but will they be the only appointors, and how may they be replaced? So oftentimes there'll be default provisions, particularly under testamentary trust wills, talking about if a particular appointor ceases, who will replace that person. So if a named appointor suffers an event of incapacity and they have an enduring power of attorney, or that named appointor dies and their legal personal representative becomes involved, should that person be entitled to stand in their shoes if that person is, for example, a spouse or somebody outside of the family unit? We're often seeing families looking at what we call a bloodline scenario, where there's a key individual or individuals picked within the family group, usually matriarchs or patriarchs or the testators, and we're saying that only people who are either lineal descendants or other blood relatives of those people can ever assume the role of appointor to keep that appointorship within the key family group. Additionally, and probably on the opposite end of the spectrum, there's consideration given to whether we should have independent people involved as appointors. Now, independent can be a very loosely applied term. Really what we're talking about is someone who's independent from the trustees themselves. So that may be someone who's an extended family member, it may be somebody who's a family friend, or it may be someone who's genuinely independent, for example, somebody who's been an accountant for a family group for a long period of time and is therefore a trusted advisor of the family. Obviously, when we're naming those independent people, they're being named for a particular reason, and I'll get to that particular reason in a second, but we do need to consider the succession of that role. So if the independent person is a family friend or wider relative, should they be replaced by the other appointors naming an independent when they cease, or should there be cascading list of potential future appointors named to replace those people? In relation to somebody who's, for example, a lawyer or an accountant and are being named because of that particular role, should it in fact be that their firm is the one who replaces them if they cease in that role, so that we maintain that independent person at a appointor level. So when we're talking about independent appointors, why is it so important? So from our point of view, in both discretionary trusts and through testamentary trusts, the default position is that decision-making will almost always be unanimous at a appointor level. Everybody needs to be on the same page and approve a decision before it's made. However, we're increasingly having positions where appointor decisions to be made by majority and therefore allowing a higher level of flexibility. So how this most commonly will work, we could go back to the creative alphabet family, and we have A, B, and C as trustees and also as appointors, but we have independent person X included, and we allow appointor decisions by majority. So practically, what does that mean? We have 4 appointors in place, so only 3 can form a majority decision. So if the alphabet family agree on what's happening, happy days, they formed a minority decision. However, if they don't, and we have a 2 against 1 scenario, the independent person X can either come in and say, yes, I agree with that proposed decision. The third child, you're being unreasonable. This was what the testator would have wanted, or it's in the best interest of the beneficiaries now. I'm going to approve that decision. And on the opposite end of the spectrum, it could be that the third child is being marginalised or oppressed by their siblings, and that independent person X can come in and vote with that child to stop a decision being made which is not in the best interest of everybody or not what was designed to occur. Additionally, there we may have certain decisions requiring that a certain person approves them as well. So it may be that, generally speaking, decisions of the appointer can be made in a particular way, but using the business asset example, if there's a key asset within the family group, if it's the business itself, potentially farmland in the farming enterprise example, that it needs a key person to form part of that majority before a majority decision can be reached. Okay, we're increasingly seeing the use of corporate appointors within the structure as well, and corporate appointors are probably a presentation unto themselves. But broadly speaking, it's a company that is incorporated specifically for the purpose of being an appointor. Now, usually that's being done when there's a significant family group involved and there are a number of existing trusts in place. The reason we're using them is it allows a single entity to be in place, often across a number of trusts, including testamentary trusts, and there's clear and tailored constitutional rights as to how shareholders are put in place, how shares are transferred over time, and how directors are removed and replaced. That uniformity is often important to make sure that we don't have a family enterprise that's undone by not having all the ducks lined up in the same way. It also can have a consistency and a separation of roles across the family group. So again, back to the alphabet family, if the intention is that A operates the family enterprise, that's fine, but it may be the case that we want B and C to have the ability to attend certain meetings and have particular approvals before A can do certain things. So A is generally entitled to run the business, but because the wealth is meant to pass to the entire alphabet family, they might be required to have certain decisions approved by the entire alphabet family group, and or any independents are involved in that structure. Obviously, that alignment of succession planning across a group is often key to make sure that it's not just what's flowing through the estate, and therefore the testamentary trust, but the existing trusts that are lined up as well. The final point I'd like to touch on before we pass over to Jamie is the consideration around disqualifying events and whether certain people should be temporarily excluded from control and benefit of a testamentary trust because a particular event has befallen them. So key examples are that a person's into bankruptcy, entities of which they were controlling, whether as shareholders or directors, are in liquidation or administration, or potentially they've suffered a relationship breakdown or a separation of relationship breakdown, as those terms are defined in the Family Law Act. So the reason you may want those people excluded is that it affords a greater level of asset protection to the overall family group. However, that needs to be juxtaposed and balanced against the fact that these are often times of high risk and high need scenarios for those particular family lines. So it's a consideration about what's best for the overall family group and what the family is trying to achieve as part of the succession, both through existing trust and through the testamentary trusts. I'll pass over now to Jamie.
Thank you very much, Alistair, for handing that over there. Thank you, everyone, for joining. Today, I'd just like to say a little bit of a caveat. I know that it's a very important issue that's about to hit us, which is the commercial industrial property tax. This presentation won't be covering it just because to do it justice would require a full 1 hour presentation, and there's a lot of detail. But certainly we've got material on our website, and of course, please feel free to, after this seminar, to forward any inquiries that you've got in relation to that new tax regime to either myself, Alistair, or Joseph, and then we can see if we can assist you and provide you with further advice. So Alistair, could I please just have the next slide? Thank you. So as a property lawyer, I tend to view that I work in a murky area where if things go wrong, particularly with taxation, there can be very bad outcomes for the client. So as a property lawyer, I like to work conjunctively with other lawyers in taxation and structuring fields, such as Alistair and Joseph, but also with the client and also with the client's accountants and financial advisors so that we can create a good outcome and minimise those taxation risks. And I think if we look at this, a key point in this slide is we can see our little meme there, and that's how I think a lot of the time government feels like. It's pay your taxes right here and right now, and that's both at federal and state level. And it's important that we work together collaboratively and get the advice done correctly before we start transacting, because if wrong assumptions are made or the wrong advice is made, then it can have really bad consequences for the client. And there's a case that I'm just about to turn to, which is a really good example of that, where either the wrong advice was given or the wrong assumptions were made, and it had pretty bad outcomes. So if we go to the next slide, Alistair. So I thought I'd use this as a little bit of a funny meme here. And this is the ATO's view in the next case that I'm about to discuss, which is Lance and the Commission of Taxation 2024. And it just came out at the start of this year. And if we start going through, so in terms of basic background, Paul Lance purchased a historical farm with a homestead on it, known as Sutton Farm, and that occurred back in 2013. And then eventually, years later, he sold the farm in 2020. But critically, the contract of sale was not subject to the words plus GST. So if we now go to the next slide, please. Sorry, we can have the next slide, please. Sorry, we're having a little bit of a technical issue there. Next slide's not just coming up. I'll just keep going then until we can get up to speed with the slides. In short, after the sale had been concluded, the ATO turned around and said to Lance, well, actually, no, you were engaging in an enterprise. And in fact, you've got to remit 1/11th of your sale price to us because it was a taxable supply. And for obvious reasons, this was problematic for Lance, because he was now going to get a lot less than initially expected. And so, of course, he appealed this, the ATO's decision to the Administrative Appeals Tribunal. So the ATO were able to get up in this situation, and they were able to correctly argue that there was an actual enterprise and that Lance was engaging in an enterprise, because when the entirety of the circumstances were looked at, there was a lot to indicate that Lance was indeed engaging in an enterprise. For example, he went early on in the after acquiring the land, he started doing puff pieces in the local newspaper, which is in the Mandurah region in Western Australia, talking about how he was going to develop the land, and there would be parts of the land utilised for a vineyard, a cafe and a winery and so forth, and potentially kind of mixed commercial use. And indeed, he actually applied for a rezoning of the farmland that changed it from the original zoning to it was a special use zone, and he was able to get that rezoning in March 2016. The other thing that he was looking at was also doing a 4-lot subdivision, but critically, he never got that across the line. But as part of that 4-lot subdivision, which he kind of did apply for, but was never finalised, he had the option for further actual subdivision of the land. Oh, excellent. Where the slides are working again. So if we go to the next slide, please. Thank you. We're working. Lance tried to say, well, hang on, there was a historical homestead on this premises, and thus my sale should be treated as input tax. The problem was, because of the historical nature of the homestead and its dilapidated state, it was going to require various permits to allow that land to be utilised. So in effect, Lance was never able to actually reside in the historical premises. He only at times periodically used a caravan when he was on site. And so the ATO kind of used that against him and said, hang on, you only got the rezoning through. You never got an actual legitimate permit to then upgrade and renovate the homestead. So there's not that residential use attracted with the land. and thus it was never occupied. Interestingly, what was also going on along during this period while he was trying to develop the land was that Lance was actually claiming input tax credits for the services and purchases that he was utilising while he was trying to get permits through, such as professional services from surveyors and town planners and various acquisitions of material that he was using to get the rezoning. So for whatever reasons, he'd got the advice from the accountant, and the accountant said, yep, claim those input tax credits for those services and materials that you bought as part of this development. But of course, it all became too hard trying to get the actual subdivision through. So in 2020, Lance then had to sell the property holus bolus without subdividing. Next slide, please. So as you can see here in this example, Lance probably didn't get the advice and just assumed that because I hadn't finalised the project, that in itself means I haven't engaged in a business enterprise and thus I don't have to worry about GST. But as we can see from this example, is that those preliminary steps that Lance took, and quite probably relevantly, claiming the input tax credits and getting that mixed use zoning, which was for more of the commercial purposes, to the land, and never getting the residential site, the permits in place to reside in the homestead was probably quite key. And so again, it becomes a situation for clients to really think about this and engage with both their lawyers and their accountants to make sure that they factor this in. Now, this is not to say that the realisation of capital argument still doesn't exist. That may have been possible in a different circumstance, but it does suggest that, using my little analogy there, that if you're trying to be safe from GST, get the advice, but it's almost like you've got to sit on the golden goose that is the land and do nothing. So next slide, please. This is another key change that's come through recently, and it is relevant, particularly because of the changes to land tax, which Joseph will discuss further. But I'll give the historical context. Previously, when a vendor sold land, at settlement, the land tax that was payable on that land, if there was any due and payable, could be adjusted at settlement between the vendor and purchaser. Now, the state government has changed this, and from 1 January 2024, that if the sale price of the property is $10 million or less, and that's inclusive, less than $10 million, inclusive of GST, then that adjustment can no longer occur. And any contract provision is unenforceable. And there are also penalty units that can apply if a vendor includes any such contractual mechanism in that contract, being 60 penalty units for an individual or 300 for a body corporate. And similarly, there is now a prohibition where if the windfall gains tax liability has crystallised, okay, and I'll just pause and say, just a gentle reminder, windfall gains tax is the more recent tax that occurs when there's been a rezoning event of the land from, for example, farmland to residential, and the government captures that value, okay, and the vendor is liable to pay that tax even if they haven't realised the sale. I won't go in further detail, but that's just a gentle reminder. But turning back to this new prohibition, what it means is if the windfall gains tax liability has crystallised or has been issued by the SRO, a vendor can no longer apportion that liability onto a purchaser. Okay. Now, the kind of policy reasons for both of these changes was in circumstances to ensure that, for example, developers are not passing on land tax liabilities or windfall gains tax liabilities onto the mum and dad ultimate consumer. Or quite relevantly, an example might be where a vendor is an investor and they're selling to a purchaser who's going to use it as their principal place of residence. Well, historically, that under the normal conveyancing conventions, that purchaser would still have to adjust for land tax, which seems a little bit unfair when it was going to be their main residence. So we've just got to think of it in those terms. So if we go to the next slide, please. There are exemptions though. So if the sale price is greater than $10 million, so this is for the exclusion on adjustment to land tax, okay, then the land tax can be adjusted as per the normal conveyancing convention. And it is good to also note that the Sale of Land Act does have a mechanism that threshold amount of $10 million will be adjusted by CPI. Also, if the windfall gains tax liability has not been triggered, so using the little analogy here, the farmer is about to sell his land to a developer, and the rezoning event has not occurred, but it's the looming iceberg on the horizon, then in that circumstance, the windfall gains tax liability can still be apportioned by contractual mechanisms because it hasn't crystallised at the day of sale. If I could just go on to the next slide, please. Okay, so in light of the changes to land tax in particular that Joseph is going to discuss, landowners when selling property now really have to think about this, because if the sale price is less than $10 million, it's going to probably create a situation where the vendor is just going to have to, at settlement, all of the outstanding land tax, including arrears and penalties, plus the actual annual land tax bill, will just be deducted against the vendor. There's not ability to apportion that. So it is important that clients start factoring that in, and that does raise the question, because it's not strictly prohibited, whether we're going to see more what I would say grossing up sale prices for both dealing with land tax situations or windfall gains tax as we move forward, people factoring that in because they can't adjust it at settlement. If we move forward to the next slide, please. I'll just quickly cover this as well, and this feeds into what a little bit of what we've seen in Lance's case and also what Joseph's going to say. But we've really got to be careful. In the property field, the SRO and ATO are sharing data, and a lot of it. So they will find high-risk transactions or high-value transactions, and they will put scrutiny in, and they will even go insofar as presenting newspaper clippings and articles to demonstrate evidence that may or may not support, your tax position. But just a little ongoing issues that we always see, which not necessarily at our end, but we occasionally have to fix by the legal practices or conveyances. But we always try to mitigate risk on double duty associated with purchase and nominations of land. And always a common one that we've seen is a failure by the purchaser to disclose that they've acquired the land as a trust. And what happens inevitably years later, there's data sharing. The SRO works out that it was actually in a trust, applies the land tax surcharge and plus penalty interest rates, and then of course the landowner gets a bill which is quite substantial years later, which they're not happy about. So again, these are kind of things that we try to work with clients and accountants to make sure that that's being correctly identified from day dot, so we're not dealing with those risks. Move on to the next slide, please. Just finally, anecdotal observations, which Joseph will discuss more. We are seeing just broadly in our department and the business department a lot more land tax objections, and this is coming about because of the new regime with the government and the increased scrutiny from the SRO. I think the other thing that's really important, and I've just found out this myself, is because a few accountants and clients have given me the feedback. Historically, when a purchaser acquired, land and it was primary production, as a lawyer, we would, fastidiously fill out the little code that would say, okay, it's primary production exempt because the client's, engaging in emu farming, and you'd find the subcode for that, and you do your bit and your notice of acquisition, and that was what signalled that to the SRO that was the land was being used for primary production. We seem to be seeing that the SRO is now taking a bit more of a view that no, that notice of acquisition lodged and prepared by the solicitor doesn't suffice. The actual landowner and tax owner needs to be more proactive and go on their SRO My Land Tax portal and actively update their records to say that it's being used as primary production. So we've seen a few transactions where it's not fatal, but after the fact, the clients has been issued a land tax assessment, even though they're clearly using the land for primary production, and then they've had to, that assessment's been withdrawn, but the clients had to take the extra time to go on and update the details to show it's being used for primary production. So just that's a take home, because it seems to be that's the way that that's now being dealt with administratively. So next page, please. Thank you. So I think just as a key sum up, We are operating in a sphere in property transactions where there's a lot of scrutiny and things can go wrong if the wrong assumptions are made or wrong advice are made. And I think really when it comes to property transactions, good outcomes to mitigate taxation risks and consequences occur when the client and the solicitor and the financial advisors work collaboratively from the start of the project, before acquisition, all the way along to settlement. But obviously key element is making sure that before a contract or agreement is signed, that everyone's on the same page and correct advice is being provided. And obviously we're more than happy to assist both clients and accountants. We have experts such as Joseph and Alistair, and we're also very lucky to have Rob Warnock and a team who can provide state and federal taxation advice. So thank you.
Thank you, Jamie. Hello, everyone. I'm the third and final instalment for today's presentation. I work in Alistair's team, and we act in a variety of commercial matters, including dealings with the SRO in relation to duties and state taxes. Land tax is a complicated area, and in an 18-minute presentation, I'll have to breeze over a number of topics and nuances where I'd otherwise devote a considerable amount of time. The topics we'll cover today include a high-level introduction to land tax, the temporary changes to the rates of land tax. I'm not doing a foreign owner surcharge, I'll skip that. But we'll also touch on vacant residential land tax, and finally, what options we have available to limit the effects of these changes. What is land tax? Land tax is a state-based tax administered by the State Revenue Office. It's levied annually based on the holdings as of 11:59 p.m. on the 31st of December each year, and is based on the total value of taxable land held in a particular jurisdiction by a particular entity. How does it apply? Where the total value of the land holding of a particular entity exceeds the relevant threshold, land tax is applied at the applicable rate unless a concession or exemption applies. Land tax assessments are sent by the SRO annually, and ordinarily the SRO can only backdate reassessments as far as 5 years unless there is evidence of fraud. Next slide, thanks, Lass. Land tax is imposed on all taxable land and is assessed to the owner of the land as of the end of the year. Examples of taxable land include investment properties, holiday homes, vacant land, and commercial properties. Quickly, some exemptions. Here are some examples of the common exemptions we find. The PPR exemption is the most common and is largely self-explanatory, but there's nothing straightforward with land tax, and there are exemptions to the exemptions. So for today, we'll just leave it at ordinarily, land tax is not payable on a person's PPR. Primary production land is another exemption we often find, and it links with the availability of the family farm transfer duty exemption, which we regularly use throughout our practice. Now, we've got some new rates for land tax. Next slide, Alas. These aren't exactly new news, as they've been effective from the start of this year. The bad news is that the rates have gone up across the board and the thresholds have gone down. But the good news is that these are just a temporary surcharge for 10 years. I'm not sure about you, but I wouldn't describe 10 years as temporary. If we were to have a temporary power outage, I'm hoping it will be around the 10-minute mark and certainly not 10 years. Time will tell whether this will in fact be a temporary rate increase, but I can't see us going back to the 2023 levels. Anyway, we see that the entry level threshold is now $50,000, which means the properties that aren't exempt land and have a site value of $50,000 or more will now receive a $500 flat charge. These changes mean that pretty much all non-exempt properties will come under the regime, and all existing liabilities have increased substantially. You have to ask what properties out there would have a land value of less than $50,000. Clearly, the change in thresholds is to capture more properties into the regime. Next slide, please, Alas. This table compares the previous rates with the current normal rates of land tax. This shows that land tax is triggered earlier, and once it's triggered, the liabilities are larger. If we take a look at land holdings worth $1 million, last year the individual landholder would have paid $2,975, and this year they will pay $4,650 on the same land. You'll also see that the percentage rates are now up by 0.1% across the board. Next slide, please. This table shows the comparisons of current and last year's trust surcharge rates. If land is held by a trust, ordinarily there will be a trust surcharge. Again, there are a number of exemptions and concessions, but for today's purpose, we just need to know that there are trust surcharges. And in this example, which we'll give, they will apply. If we think back to our $1 million example, in a trust, last year the tax bill will have been $6,438, and this year it will be $8,163. Each margin has also increased by 0.1%. Given the price of land in the current market and the reduction of thresholds, these tables show that land tax is a far-reaching regime. So on to vacant residential land tax, which is our next topic. This is a further tax in addition to general land tax and is imposed each year on land in Victoria that is vacant. The three main principles for VRLT to apply are, number one, the property must be vacant. That means the property is unoccupied for 6 months or more for the year. Now that can be 6 months continuous or aggregated. The second point is the property must be residential. That is, residential land that is able to be used primarily for residential purposes, i.e. with a house or an apartment. Also, land on which a residence is being renovated or former residence which has been demolished, and land where a new residence is being built. Number three, it applies to all residential land in Victoria. Previously, this tax only applied to the metropolitan land, but this has now been expanded to apply to all residential land in Victoria. Next slide, please, last. So we've got the progressive rates. So from the 1st of January 2025, these progressive rates will apply to VRLT. You'll note the words capital improved value. That's an important difference from land tax. Where land tax is based on the site value or the value of the land without the improvements, VRLT is based on the capital improved value, which includes of improvements, i.e. dwellings, structures, and whatever improvements you've got. The progressive rates apply for each year that the property remains vacant and max out at 3% of the capital improved value if the property is vacant for 3 or more years. So if we go back to our earlier example of the $1 million piece of land, let's say for the sake of the example that the capital improved value is 1.5 million. Let's also presume that the land is held by an individual. It's not their PPR. It's been vacant for 8 months of the year, and it's not being used as a holiday home. Their tax liability from the SRO will be $4,650 for the land tax, plus $15,000 for the VRLT. And that $15,000 is the 1% of the capital improved value, which is 1.5 million. So the total liability will be $19,650. If the property is vacant for a second year, then the total liability will be $34,650. So in a very short period of time, that liability grows significantly. Landowners should ensure that residences are occupied, are habitable, or available for occupation. If occupation can't be satisfied, then landholders may look at restructuring their holding or sell the land. We'll now have a look at the holiday home exemption. There are a number of exemptions to VRLT, including if the land is exempt from land tax. So that goes back to the long list of exemptions that we had earlier in the presentation. But for today, we'll look into the popular holiday home exemption. Now, the general principle is the property has to be owned by a natural person. The property is a holiday home and is used by the owner, all the owner's relatives, for at least 4 weeks of the year. And that owner has a separate principal place of residence in Australia. With all that being ticked off, the exemption should apply. The bad news is this exemption doesn't yet apply to properties held in a discretionary trust. The current rules are clear that it must be an individual who owns the property. It must be a holiday home. The owner must have a separate PPR in Australia, and the owner or their family have to use the property as a holiday home for the cumulative 4 weeks in a calendar year. Families should consider they should consider the use and eligibility requirements for holiday homes and make sure the threshold is met to avoid VRLT. A simple logbook or a journal showing the dates and people using the property should be enough to satisfy the evidentiary requirements. Completing the logging and the journaling on a as-you-go basis provides greater accuracy for the landowner. And as Jamie mentioned, nowadays, due to the data sharing between government organisations and big corporations, the SRO has access to huge amounts of our digital information, such as phone records, utility usage, credit card usage, all which can be used against the individual when claiming that properties are being used for a particular purpose. So if you're claiming that it's a holiday home, it has to be genuinely used as a holiday home. If it's not, then we have to be aware that the SRO has access to that data and they can mount applications against you. Our advice to families is to also consider their position as a whole. Given the expense of VRLT, it could be worth restructuring ownership to avoid this tax, but restructures have other consequences and consideration needs to be given to the whole family structure rather than just focusing on the one specific tax. So this is good news for families, although they still have to meet the eligibility criteria. But does this mean that trusts and companies are completely left out of this exemption? Not exactly. The State Taxation Amendment Bill is currently before the Legislative Council, which means it's not yet Victorian law. In its current form, it provides some relief to VRLT for properties held in a family trust. Now, these are the requirements. We've got number one, the trust must have held the property at 28th of November 2023, or if not, the property had to be under a contract in favour of the trust as of that date. The second point, there has to be no change to the specified beneficiaries of the trust since 28th of November. Number three, a specified beneficiary who is a natural person or a relative of that person used and occupied other land in Australia as their PPR. Point four, in the year preceding, the land has been used and occupied as a holiday home, again, for at least 4 weeks by a specified beneficiary or a relative who meets the PPR requirement in the third paragraph. And finally, the SRO is satisfied that the property is used as a holiday home. We've already discussed the kind of things that the client should do to confirm the holiday home status and the information that the SRO has access to verify the overall use. Now, there is a similar exemption or proposed exemption for unit trusts and companies. However, at least 50% of the shares in a company or 50% of units in a unit trust must be held by natural persons who hold a principal place of residence elsewhere in Australia. This requirement, given general structuring advice, is likely to be too restrictive to be widely used, but time will tell. So what can we do? Next slide, Elias. Yep. So what can we do about land tax? Our preferred position is to always deal with the issues before an assessment is issued, but the reality is that's not always possible. If a client comes to you with a land tax assessment and says, what do we do about this? What's our response? Well, it depends. We can usually object to land tax assessments on two grounds. First, the application of the law is incorrect, or the valuation of the property. If any of the exemptions to land tax should be applied to the assessment, but the SRO have failed to do so, we can then write to the SRO notifying them of the error and requesting a reassessment. These letters can vary in complexity, and we submit to the SRO what the relevant law is. We apply the law to the current circumstances and confirm the legal position. The SRO, usually after many months, then write back to us to confirm whether or not our objection is successful. At the moment, we're finding that the SRO are issuing a significant amount of assessments to landholders where, for example, the land has been used for primary production and that use hasn't changed. But in the mail, they receive 5 years worth of land tax assessments without any in-depth explanation. Now, maybe these have been mistakes, or maybe the SRO, the State Revenue Office, are working on the revenue component of their name. But we presume there would be many landowners out there that would have received the bills and have paid them and not double checked with their lawyer or accountant whether or not they should have been paid. So it's our job to educate the client and keep other professional advisors updated so that new land tax assessments are scrutinised appropriately. If a client receives an assessment, we want them to be confident enough to ask, should I be paying this? The second way we object to land tax assessments is on the basis of the valuation of the property. If the client believes that land tax should be payable, but the land or site value is too great, then we can apply to have the valuation reassessed. These objections, in my practice, aren't as common, as the SRO use data from Valuer General and other government agencies to come to their site values, but it is an option that is available. Other options that are available in terms of dealing with land tax is that if a property is held by a trust or discretionary trust and is being used as a principal place of residence for a beneficiary of that trust, and the trust is receiving land tax assessments at the surcharge rate, then we could make a distribution of that land to the beneficiary and nominate the property as their PPR. The PPR nomination provides an exemption to land tax. If we distribute the property from the discretionary trust in accordance with Section 36 of the Duties Act, then we can also obtain an exemption to stamp duty. So that's a win-win. There are a number of evidential requirements for this duty exemption, but basically the distribution has to be made to a beneficiary who was a beneficiary of the trust at the time the trust acquired the property, and the transfer has to be for nil consideration. Nil consideration sounds simple, but it can be complicated, especially if there are debts in the trust, but we can usually work around these issues. That being said, these types of transfers will trigger capital gains tax. So that has to form part of the client's consideration to decide whether the long-term exemption to land tax is worth paying the CGT liability and other professional costs. There is a formula that can be used to show that over X amount of years, whether the benefits outweigh the expenses. There's a similar duty exemption for self-managed super funds transferring properties to their members, and we have seen an increase in these types of transfers as clients are wanting to get their properties out of the land tax regime. I'm running slightly over, but if you can bear with me for a little bit longer, I'll leave out grouping for now, as it was mentioned by Alistair. But I will say that all non-exempt land held by an individual is aggregated and grouped so that the individual pays land tax on all of its land holdings. So John Smith is the sole proprietor of 3 properties. He has a half share in 2 others and a 1% interest in another. The value of all those shares are aggregated, and John pays the one assessment based on the value of all of his properties. Therefore, it could be advantageous to hold the separate properties in separate discretionary trusts, as discretionary trusts aren't aggregated. Even with the surcharge, it could be better than having the properties in the individual name. The other viable option is to have the separate properties in separate SMSFs, as SMSFs are also not aggregated and they pay the ordinary rate of land tax rather than the trust surcharge. Despite the many changes in the superannuation area, it is still an excellent environment to hold investments. My last anecdote is we had a client who had millions of dollars of land in his single super fund, and the proposal was to transfer the land to about 8 different SMSFs so that each only had 1 or 2 properties. Some transfers were exempt from duty, some were purchases between the funds, and once the accountant ran the numbers, it was going to take about 8 years for the land tax benefits to outweigh the CGT duty and legal fees. And a quick note that SMSFs generally pay a lower rate of CGT as well. I acknowledge that this proposal is not always a viable option for all clients, and as always, we focus on the whole family structure rather than just the one or two liabilities that are trying to be avoided. 2 minutes over time, that's the end of my presentation. Thank you for your attention, and I'll pass back to Alistair if technology allows us.
Beautiful. Thanks, Joe. Thanks, Jamie, for the presentations today. We do acknowledge there have been a couple of questions that have come through over the course of today. As we are over time, Jay and Rob, we will get back to you separately rather than having the presentation run over time. So thank you to everyone for your attendance today. And as we said at the outset, we will be sending out slides and a recording of the webinar in due course. Thank you guys. Have a great day.